So, good evening, everyone. Thank you for attending our call today to discuss the HDFC Nifty Top 20 Equal Weight Index Fund. So, the NFO for this index fund is starting on Friday, that is the 7th of March, and it will end on 21st March. So, it's around a 2-week NFO. So, in the presentation today, we want to cover, what are the basic ideas, behind this fund. So, what kind of stocks will the fund invest in, and what are the main reasons as an investor to consider this particular index fund at the current market juncture, right? So, first thing that's important to mention right at the beginning is that this is a large cap focused fund. In fact, it's a 100% large cap fund. And not only that, it's actually choosing the top 20 largest stocks from the Nifty 50. So Nifty 50 itself is a large cap only index. It's India's 50 blue chips in a single index, and this top 20 equal weight index goes one step further because from within the Nifty 50 it chooses the top 20 companies by size. So what you are doing in effect is you are getting exposure to the leaders among the leaders, right? So it's like the bluest of blue chips, top 20 names are what the index will be, are the index constituents, and they each have equal weight in the index, so around 5%. So this is in effect, sort of anyone who is generally more keen to invest in large caps. It's giving you exposure to large caps, but without market cap bias. So we'll understand all these points in the subsequent slides. So just to give you an outline of what all points we'll cover in this presentation. First one is just going to sort of discuss how these 20 stocks are really the leaders among the leaders. What is so special and unique about them, what are their USPs. So we'll just talk very briefly about that. Then we'll see that in constructing an index, by just choosing the top 20 stocks and giving them equal weights, you end up with a product which has pretty diversified sector exposure, given that there are only 20 stocks. So, for example, right now or as of end of Jan, just this 20 stock index had exposure to almost 10 different sectors, right? And you'll also see that the sector exposure is quite differentiated compared to the parent Nifty 50 index. Next thing which is very important is to see how the equal weighting mechanism gives the basically reduces the risk of stock concentration and gives the investor better diversification. So just as to take a few numbers and put it into context, right now in the Nifty 50, the top three constituents, just three stocks out of the 50 stocks, account for almost 30% of the total weight. But if you look at the Nifty top 20 equal weight index, because each stock has a weight of around 5%, there the top three stocks only account for around 15 to 16%, right? So you're getting exposure to 20 stocks, getting exposure to around 9-10 sectors, which is quite diversified. And very importantly, you are getting at the stock level itself, you are getting a much more balanced exposure to the 20 stocks in the index. So you don't have a risk that just 2 3 big stocks are going to dominate your returns profile. That is actually that market cap bias is spread quite equally among all the constituents of the index. One of another reason to consider investing is that the strategy has historically generated better long-term returns than the Nifty 50. So this concentrated portfolio equal weight is actually done better than the Nifty 50 over the long term. And another thing to consider, why we were talking about why this as an interesting product in the current market environment is the large cap focus. So we'll see two slides in particular which are talking about how currently large caps valuation is, the premium that they have is lower than the broader market, and also their percent as a broad market cap is close to decade lows, which means that both these are making strong, relatively, sort of strong points in favor of large caps given the market weakness we've seen so far, that large caps could be a little bit of, in a sort of relatively better spot than other parts of the market. So this is what we'll cover in the subsequent slides. First slide is just kind of emphasizing, how sort of, when we said that these companies in the index are the leaders among the leaders, when you look at the names given on the left hand side, it's very clear, why we've used such terminology. So these are, very well known companies. They have been around for, in many cases, decades. They are either dominant in India or dominant sometimes, or have a very large exposure globally. So these are the top 20 companies of India by size, and they, as such, they represent a very interesting portfolio and of very large, well-run companies for you to invest in the long term, right? So again, message from this slide is that you are really getting exposure to the Nifty 50 itself is an index of leaders, and these top 20 are the leaders among the leaders. So here we'll just take, it's a very simple concept, but just to make sure that everyone is clear, how the index works. As I mentioned, the parent index is Nifty 50, which means that the methodology states that the top 20 largest stocks from the Nifty 50 index will be included in this top 20 equal weight index. So from the Nifty 50, the top 20 by free float market cap are included. And as the name suggests, because it is an equal weight index, each constituent, so that means each of the 20 companies will get equal weight. In that case, simple math tells us that's around 5% weight each. Okay. And the weights of the companies are reset to 5% at the end of each quarter. And the portfolio is reviewed every basically semi-annually. So in March and September, in sync with the frequency for the Nifty 50 itself. So every March and September, as the names of the Nifty 50 index change, the top 20 equal weight index constituents may also change depending on if one company has entered the top 20 or fallen out of it, depending on the share price movements in the interim. So very simple. Main takeaway is that subject to buffer, you are choosing the 20 largest stocks from the Nifty 50 index, and each of them has 5% weight each. So this slide just shows you that even with a 20 stock portfolio, you still have quite a fair amount of sector exposure. So just these 20 stocks are giving you exposure to around 9 sectors. Temporarily, it was 10 because for a brief period of time, ITC Hotels was in the index. But if you exclude that, it's around 9 sectors. And we've also compared the weights of this index to the parent Nifty 50, right? So you can see that if you invest in the equal weight index, you get more exposure to consumer durables, autos, and FMCG, and relatively less weight to oil and gas, financial services, and metals and mining. So within this top 20 stock index, you get exposure to 9 sectors, and you also have this kind of differentiated sector exposure. So that was, how basically making the point that you have good sector diversification. Now let's really look at this part, which is talking about the stock diversification. So if you go back to, what I was describing earlier, that sometimes a few stocks in an index, they may dominate the index. So what do I mean by that? If you look at Nifty 50, for example, the largest 3 stocks there are HDFC, ICICI Bank, HDFC Bank, ICICI Bank, and Reliance Industries, right? Now, just these 3 stocks alone have around 30% of weight of the Nifty 50 index. So I'll say that again, 3 stocks in the Nifty 50 have around 30% of the weight. What happens though when you are doing an equal weight index in this top 20 format is that the same 3 companies now have around 5% weight each. So while HDFC Bank, ICICI Bank, and Reliance Industries were around 30% in the Nifty 50, their weight in the top 20 equal weight index is now lower at around 15%, 15 to 16%. right? So what happens is companies with very large weights in the Nifty 50 will see their weight shrink, as I've just described. And also, companies which have small weights in the Nifty 50, they will see their weights go up in the equal weight index. So that's what we can see in the second table, that names like HCL, Axis Bank, ITC, or even a Maruti Suzuki, they have relatively small weights in the Nifty 50, just sub 3%. But in the equal weighted version, they have weights around 4 to 5%, right? So what the equal weighting mechanism does is it reduces the weight of the big companies, boosts the weight of the relatively smaller companies, and everything is sort of fixed at 5% on the rebalance dates. So in this way, that's why we've said this in the title of the slide. By using this equal weight mechanism, you avoid market cap bias. So you avoid just a few companies having a disproportionate influence on the outcome of the index performance, right? With equal weighting, you are now giving each company at the time of rebalance an equal chance to contribute to the return of the index, right? So this is, I think, a very important USP of this product, that equal weighting removes any market cap bias that may have existed previously. So I think last slide before I hand it over to Sandeep, just again want to show that the index as a whole, from inception, which is around 2006, that's the initial point from which we have backtested data. It's shown that it has been able to outperform the parent Nifty 50 in the long run. So not only in the long run, but also over shorter time periods like 1, 3, and 5 and 10 years. So since inception in 2006, this index has given around 13.7% CAGR compared to 12.6% for the Nifty 50. And if you look at any of the shorter term horizons, again, the top 20 equal weight TRI has done better than the Nifty 50 TRI. So this is an example of how this concentrated portfolio of the leaders among the leaders historically has done better than the wider Nifty 50 index. And with that, I'll hand it over to Sandeep, who will take you through the remaining returns and other USPs of this product. Sandeep, I'll hand it over to you now.
Okay, thanks, Shikhar. So, as you can see that in continuation, if you look at the returns financial year wise also, um, this in the last 18 financial years, 12 years, there has been an outperformance out of the 18 years of this Nifty 20 equal weight TRI index was the Nifty 50 TRI. And I think it is worth noting that in last 3 years, FY 23, FY 24, and year to date FY 25, also there has been a outperformance of this fund over the Nifty 50. Uh, Next slide. And if one looks at the returns of particular is done pretty well once, yes, in comparison with the new adjusted basis also it has very free of time period for the 4 time period as compared with the Nifty 50. So this shows that even on a rolling return basis, the return will be higher for the Nifty 20 equal weight as compared with Nifty 50 TRI. Okay, next slide. Now look at it how this index has done when the market has fallen. So typically this has done much better than the Nifty mid cap as well as the Nifty small cap indices when there have been bouts of basically stress in the what do you call market. It has fallen much lower than the what do you call Nifty mid cap index as well as the Nifty small cap index. So this particular product has done pretty well as compared with the Nifty small cap as well as the Nifty mid cap index. As you can see, even in the recent period, December 17 to 20, it has fallen. It had fallen only 18% as compared with 37% for mid cap and 55% almost for small cap index. So in bad times, this product has outperformed mid cap and small cap, as can be seen from this chart. Next slide. If we look at the valuations for large caps, basically the valuations have come close to their long-term averages. On Nifty forward PE is now very close to its long-term average, and which shows that a lot of the conventional what you call or the most common opinion is that large caps are reasonably valued currently on a 1 year basis, that even on a 12-month basis, I think the cap index goes to slightly lower than the tech fund. So this makes getting large margin because there's been the meaningful. So as I said, the valuations for large caps in this chart, it is slightly above long-term averages. If you look at the current market scenario, we are actually at long-term averages, just about at our average for Nifty 50, which is around 19-20 times. And looking at the growth potential of India, the GDP number. So the numbers are very pretty, and that's why we feel that it's a good time to start investing in the large portfolios. Shikhar, I can't hear you. Yeah. Next slide. Can you go to the next slide? Yeah. So the large cap share of the total market cap, that is the Nifty 500 stock, which we compare with in the universe also as a percentage, large caps share has fallen, and it's at decadal lows, which also shows that the large caps are attractively valued if one looks at the total Nifty 500 universe. So that also gives us a good reason to consider investing in large caps at this particular juncture. Next slide. Okay, now if we look at the valuation, further, if we do a relative comparison of this Nifty top 20 equal weight with the Nifty 50 index, the top three stocks in the Nifty 20 equal weight index um is around only 16.8% vis-a-vis 28.8, that is nearly 30% of the index is in the top three stocks in the Nifty 50. So on a P/E ratio basis, if we see this data as on 31st January, the P/E ratio is very similar to the Nifty 50. It's at 22 times versus 21 times. The price to book ratio for Nifty 50 is slightly lower at 3.5 times, and price to book for this index is at 4.3 times. But the dividend yield is 1.24% versus 1.38%. So on a valuation parameters, there is not much to choose between Nifty 20 equal weight and the Nifty 50 index. But as you can see that the top constituents of Nifty top 20 equal weight, which Bajaj Mundra, Hindustan Lever, and Reliance, and so on and so forth. Look at the top constituent in the bank ICICI and bank industry with the six and ICICI would be possibly at 9% and followed by Reliance at 8%. So, from that perspective, this is a differentiated index as compared to the Nifty 50 index. And at the same time, these top 20 issuance give you the exposure to large caps. So, to invest in this Nifty top 20 equal weight index fund, large caps currently have lower valuation premium than the broader market. And that is one of the compelling reasons to invest in this fund. And within the large caps, also these 20 stocks generally are the sector leaders in their respective business. They have a leadership position. And so from amongst the, 50 largest companies by free float market cap, you are selecting 20 companies which also enjoy leadership status in that business. And you get a differentiated sector exposure because of this 5% equal weight to the top 20 stocks, and there is a lower stock concentration risk as compared to Nifty 50 because of this equal weight allocation of 5%. And because currently the way the Nifty is designed, so the top three stocks constitute nearly 30% of the weightage, and top 10 stocks would be nearly 50% of the weightage in the Nifty 50. Okay, next slide. Some key strengths for HDFC AMC in the passive business, that is the index solutions business. It has been around for 20 plus years, and we have a very long experience in managing passive products, both index funds and ETFs. We currently have a very wide product range. We have 19 ETFs, we have 23 index funds, and 3 fund of funds. So 7 ETFs and 9 index funds in market cap based products. We have in sector based ETFs, there are 4 products, and index funds, there are 2 products. Smart Beta, we have 5 ETFs and 4 index funds. For commodities, we have the gold and silver ETF, and we also have 2 feeder funds, HDFC Gold Fund of Fund and HDFC Silver ETF Fund of Fund. And we have 8 debt index funds and 1 liquid ETF, and we also have 1 international offering, which is a fund of fund. So we have leadership across market cap based funds on the index side, and also a small cap ETF is a leader in terms of AUM in its category. Uh, and our gold ETF has over 12 years of what you call history, since it's have fairly a wide, what you call, wide bouquet of products. Plus, we have a long experience in managing the funds, and we have done so efficiently. So that demonstrates our strength in this index and ETF business. Okay, so this fund is an open-ended fund which replicates the Nifty Top 20 equal weight. The fund managers are Nirman Morakia and Arun Agarwal. There is no entry or exit load in the scheme. And the minimum amount for purchase and additional purchase is rupees 100 and any amount thereafter. So I think we can open for Q&A, Shikhar.
Yeah, Sandeep, would you mind just repeating, what you were saying on slide 12 about valuations, because your voice
Okay.
got clear, very distorted at that point. So
Yeah.
for
Okay. So I think as per that slide, if you look at it, that the Nifty forward P, which is as per this slide, as on the date that we prepared this slide, it is slightly above the long-term average for the Nifty. In the last, as you can see, this is a chart basically. So around 21 times, I think, or 20 times is the 1 year forward PE, and it is quoting slightly above this. But from then on, since we have made presentation, the market is corrected still further. So actually, the currently at the current index levels, the 1 year forward PE actually has gone below the 10-year average as well. So large caps, because of this, have become very reasonably valued, and it gives you a cushion or a margin of safety when one is investing in the large cap space. And looking at the GDP numbers which have come out last week, and expected better numbers this Q4, and considering the size of the economy, I think the GDP growth is here to stay. The slowdown which was evident in Q2 was more of a cyclical slowdown than a structural slowdown. And I guess once the corporate earnings cycle revives, then you could see some re-rating again in the what you call from a returns perspective in the large cap universe. So I think our main point is that the long-term average of the large caps on a forward PE basis, we are close to the 10-year average or slightly below the 10-year average currently.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.